So you want to own a private prison, a government contract that pays you for every single person inside your facility, every single day, whether the economy is booming or crashing, whether unemployment is high or low, whether the stock market is up or down. No customers to acquire, no product to market, no demand to generate. The government sends you the people, the government pays you the bill, and you collect a check every month for as long as the contract runs. Then on the surface, it sounds like one of the most recession-proof businesses ever invented. The reason private prisons look like guaranteed income machines is the same reason the two largest private prison companies in America have spent decades fighting legal battles, absorbing political scandals, and watching their stock prices swing violently on nothing more than a single policy memo from a new administration. The business model is real. The stability is not. Let's start with what you're actually buying. Because a private prison isn't really a corrections business. It's a government contracting business that happens to house human beings. And that distinction matters more than almost anything else in understanding how the money actually works. The United States incarcerates more people per capita than any other country on Earth. As of the most recent federal data, roughly 2 million people are held in American jails and prisons on any given day. Of those, approximately 8%, somewhere around 160,000 people, are held in privately operated facilities. That number has fluctuated significantly over the past 2 decades. But the core business opportunity has always come from the same place: government agencies, federal, state, and local, that need bed space and are willing to pay someone else to provide it, rather than build and operate their own facilities. Before you collect a single dollar, you need to understand the fundamental structure of how private prisons actually get paid, because it is nothing like how most businesses generate revenue, and the differences explain almost everything that follows. The primary payment mechanism is a per diem rate, a fixed dollar amount paid by the government for each incarcerated person housed in your facility each day. Per diem rates vary enormously by contract, by jurisdiction, and by the security level and special needs of the population being housed. A basic minimum security federal contract might pay somewhere around $50 to $60 per person per day. A contract to house high security or special needs populations, people requiring medical care, mental health treatment, or immigration detention, can pay considerably more, sometimes north of $150 per person per day. On the surface, those numbers sound modest. Multiply them across a facility holding 1,500 people for 365 days, and you're looking at gross annual revenue somewhere between $27 million and over $80 million, depending on the rate, before a single operating cost is subtracted. Here's the detail that catches almost every outside investor off guard. The per diem rate is not the same as profit, it is revenue. And the costs of actually running a correctional facility are substantial, relentless, and largely fixed, regardless of how many people happen to be inside on any given day. Staffing is the single largest cost in this business, typically consuming somewhere between 55 and 65% of total operating revenue. A prison cannot function below a minimum staffing level regardless of population. You need correctional officers on every post, every shift, 24 hours a day, 7 days a year, whether the facility is at 100% capacity or 60%. You need medical staff, because incarcerated people get sick and the facility is legally required to provide care. You need food service, maintenance, administrative staff, case managers, and security technology. None of these costs shrink proportionally when population drops. They just eat a larger percentage of a smaller revenue base. This is why the concept of guaranteed minimum occupancy clauses matters so much in this business, and it's one of the most controversial financial mechanics in the entire private prison industry. Many private prison contracts include provisions requiring the government to pay the operator for a minimum percentage of the facility's bed capacity, regardless of how many people are actually housed there. These clauses, sometimes called lockup quotas, have appeared in contracts requiring governments to guarantee payment for anywhere from 80 to 90% of total bed capacity, whether filled or empty. The logic from the operator's perspective is straightforward. If you build a 1,500-bed facility specifically for a government contract, you have fixed costs tied to that capacity. If the government sends you only 900 people, your costs don't fall proportionally, but your revenue does, unless the contract requires the government to pay as though a larger percentage of those beds were filled. Critics of these clauses argue, with some justification, that they create a financial incentive for high incarceration rates that is embedded directly into the government's own contractual obligations. Supporters argue they are simply the economic equivalent of a hotel demanding a minimum room block commitment from a conference organizer. The operator built the capacity to spec. The government should bear the cost of underutilization. Both arguments have merit. What is not in dispute is that these clauses have appeared in real contracts and have transferred meaningful financial risk from the operator back to the taxpayer. So say you've won a contract, you have your facility, and people are being housed. Now let's talk about the cost structure in more detail, because the operating economics of a correctional facility are genuinely unusual compared to almost any other business you might own. Labor is not just the largest cost, it is the most volatile and the hardest to manage. Correctional officers, the frontline staff who actually maintain order and safety inside the facility, are in chronically short supply in many regions of the country. Turnover rates at private correctional facilities have historically run significantly higher than at government-operated facilities, sometimes exceeding 30% annually. Every time a correctional officer leaves, you pay to recruit, screen, background check, and train a replacement. Training a new correctional officer from scratch takes weeks and costs real money. And during the training period, you often have to run existing staff on overtime to maintain required staffing ratios, which means you're paying premium labor costs precisely when your facility is at its most understaffed. The labor trap in private corrections is this. The business model creates pressure to minimize operating costs to maximize the margin between the per diem rate and the actual cost of housing someone. But correctional work is inherently dangerous and demands a qualified, experienced, attentive workforce. Cutting labor costs in a prison is not like cutting costs in a hotel or a restaurant. The consequences of understaffing show up in documented ways: increased violence, inadequate medical care, and the kind of incidents that eventually end contracts, trigger lawsuits, or generate the congressional scrutiny that can undo an entire operating license. Then there is the physical plant itself. A prison is one of the most infrastructure-intensive buildings that exists. Security systems, surveillance cameras, electronic door controls, perimeter fencing, and specialized plumbing and electrical systems all require constant maintenance, upgrade, and replacement. Many private prison contracts require the operator to maintain the physical facility to government-specified standards, which means the operator cannot simply defer maintenance the way a landlord might let a commercial building slide between tenants. The government's inspectors come in and they count the broken locks and the inoperative cameras, and if the count is too high, the contract is at risk. Here's a structural peculiarity of this business that has very few parallels anywhere else in American commerce. Your customers are involuntary. The people inside your facility did not choose to be there, cannot choose to leave, and cannot choose a competitor. Your actual customer, the entity you have to keep satisfied, is the government agency that signed your contract. This creates a business where your primary relationship is not with the people you serve, but with the bureaucracy that sends them to you and pays for their housing. And that bureaucracy can change its mind. The entire business model of private corrections rests on a single assumption, that the government will keep sending people and keep paying the bill. When that assumption holds, private prison economics work reasonably well. When it breaks, the consequences are swift and severe. This brings us to the single most important and most underappreciated risk in private prison ownership: political risk. Unlike almost any other business where competition risk, technology risk, and economic cycle risk are the dominant concerns, the private prison business is dominated by a risk that has nothing to do with how well you run your facility. It is the risk that the government decides, for policy, political, or ideological reasons, to stop using private prisons entirely. In August of 2016, the United States Department of Justice announced that it would phase out its use of private federal prisons. The announcement came after a critical report from the department's own Office of the Inspector General, which found that privately operated federal facilities had more safety and security incidents per capita than comparable government-run facilities. The stock prices of the two largest private prison companies, CoreCivic and the GO Group, fell between 35% and 40% in a single day following that announcement. Companies that had been generating hundreds of millions of dollars in annual revenue from federal contracts suddenly faced the prospect of losing a significant portion of their business with almost no transition period. Then the administration changed. In February of 2017, the new administration rescinded the phase-out memo. Stock prices recovered, federal contracts were renewed, and the industry returned to something approaching normal operations. 4 years later, in January of 2021, another administration issued another executive order directing the Department of Justice to phase out private prison contracts again. Stock prices fell again. Contracts began to wind down. the cycle repeated in the opposite direction. No other business of comparable scale in America is as directly and immediately subject to single administration policy reversals. A private hospital, a logistics company, a real estate portfolio, none of them can see their fundamental business model altered overnight by a memo from the Attorney General. Private prisons can, and that vulnerability is priced into every valuation model, every contract negotiation, and every investor presentation in the industry, whether or not the people writing them choose to say so explicitly. Now let's talk about the ownership structure of these businesses, because it's one of the most counterintuitive facts in the entire industry, and it explains a great deal about how private prison companies have maintained investor interest despite the political volatility we just described. Both of the major private prison operators in the United States, CoreCivic and the GEO Group, have at various points structured themselves as real estate investment trusts, commonly called REITs. A REIT is a corporate structure that allows a company owning income-producing real estate to avoid paying corporate income tax, provided it distributes at least 90% of its taxable income to shareholders each year. The logic of applying this structure to private prisons is that the facilities themselves are real property, and the company is collecting rent-like income from the government for using those facilities to house detainees. From a purely financial engineering perspective, the REIT structure allowed these companies to convert their prison buildings into tax-advantaged real estate assets and offer investors a relatively high dividend yield at a time when yield was difficult to find in other asset classes. Critics pointed out that treating a detention facility as income-producing real estate in the same category as an apartment complex or an office building obscured the nature of what was actually being monetized. Supporters pointed out that the structure was legal, was approved by the IRS, and provided investors with returns. Both observations are accurate. The asset, the physical building, has value. The contract flowing revenue through that building creates the yield. The question of whether the business inside those walls is well-run, humane, or sustainable is a separate question from the one that determines the stock price on any given Tuesday. The immigration detention market has become an increasingly important revenue source for private prison operators, and it operates under a somewhat different contract structure than traditional state or federal criminal corrections. Immigration and Customs Enforcement, commonly called ICE, contracts with private operators to house people in immigration detention pending deportation proceedings or asylum hearings. ICE detention contracts have tended to pay higher per diem rates than criminal corrections contracts, in some cases considerably higher, reflecting the higher administrative cost of managing a population in legal limbo whose status can change rapidly based on court decisions, policy shifts, and diplomatic relationships between the United States and other countries. The immigration detention population has fluctuated enormously depending on border enforcement priorities, reaching peaks above 50,000 people in recent years and dropping sharply during periods of reduced enforcement activity or court-ordered release programs. For private prison operators, this volatility has created both significant upside during high enforcement periods and significant downside during policy-driven contractions. A company that expanded capacity to serve the immigration detention market during one administration can find itself with expensive empty beds when the next administration shifts priorities. Here is a cost most people outside the industry never think about at all: the cost of litigation. Private prison operators face a volume and variety of lawsuits that would bankrupt most businesses of comparable size. Civil rights lawsuits alleging inadequate medical care, excessive force, unconstitutional conditions of confinement, class action suits brought on behalf of entire facility populations, wrongful death claims, suits challenging the legality of particular contract provisions. The two largest private prison companies carry substantial legal liability on their balance sheets at any given time, and the cost of defending, settling, or losing this litigation is a real and recurring operating expense that rarely appears in the simplified revenue minus operating cost financial presentations used to pitch this business to outside investors. A single major adverse verdict can consume an entire year's profit from a facility. A pattern of adverse verdicts attracts regulatory scrutiny that threatens the underlying contract. Let's run the real math on a single facility, the way an operator actually has to run it. Take a hypothetical 1,500-bed facility operating under a federal contract paying $60 per person per day with an 85% minimum occupancy guarantee. At full capacity, that's $32,850,000 in annual revenue. The minimum occupancy guarantee means even if the facility runs at the guaranteed floor, the operator receives payment for roughly 1,275 beds, generating annual contract revenue of approximately $27,900,000. Against that revenue, subtract staffing costs at 60% of revenue, call it roughly $16 to $20 million depending on overtime requirements and turnover levels in that year. Subtract food service, medical care, utilities, and facility maintenance at another 15 to 20% of revenue, roughly $4 to $6 million. Subtract insurance, legal reserves, technology, and administrative overhead at another 5 to 8%. What remains before debt service in a well-run year is somewhere between $3 and $7 million in operating income on a facility that cost somewhere between $50 and $80 million to build or acquire. That's an operating margin of somewhere between 10 and 22% in a genuinely good year on a capital investment that ties up $50 to $80 million of real money. Now the bad year. The contract is up for renewal, and the government agency has used the leverage of the renewal to renegotiate the per diem rate downward by $8 per person per day. That sounds like a small number. Across 1,500 people for 365 days, it is $4.3 million less annual revenue on a cost structure that barely moved. Your staffing costs didn't fall $8 per person per day. Your medical costs didn't fall. Your insurance didn't fall. A correctional officer who quit during the year was replaced at higher wage due to a tightening labor market, and you ran 6 months of overtime to cover the gap before the replacement was trained. A federal inspection flagged maintenance deficiencies that cost $800,000 to remediate before the next inspection cycle. And a class action lawsuit challenging conditions at your facility cost $1.2 million to settle, which your legal team recommended because going to trial would have cost more and carried greater reputational risk going into your contract renewal. The difference between the good year and the bad year on this exact facility, same building, same contract, same population, can be the difference between a reasonable return on capital and a year where the facility generates essentially nothing after all costs are accounted for. That swing, driven by a combination of factors entirely outside your operational control, is what makes private prison investing fundamentally different from almost any other infrastructure or real estate investment that superficially resembles it. So does owning a private prison actually work as a business? The honest answer is that it has worked, in the specific sense that 2 large companies have generated substantial revenues, paid substantial dividends, and maintained substantial market capitalizations doing exactly this for several decades. But the framework through which it works is not the one the pitch describes. It is not a stable government contract business with predictable bond-like cash flows. It is a politically contingent business, where the underlying demand for your product is determined not by consumer preference or economic cycle, but by incarceration policy, which is determined by elections, court decisions, sentencing reforms, and the ideological composition of the executive branch at any given moment. None of those factors are within the operator's control, and none of them can be hedged the way you might hedge commodity price risk or interest rate risk. A private prison isn't really a corrections business or a real estate business, even though the contracts and the REIT filings make it look like both. It is a business whose fundamental product, a guaranteed population of government-assigned residents, exists only as long as the government chooses to supply it. The building doesn't disappear when the contract ends. The fixed costs don't disappear. The debt service on the facility doesn't disappear. The only thing that disappears is the government check. And in this business, unlike almost any other, the government check is the entire business.